Not really, no. Well, then let me get started and just advance the slide. Test.
Thank you, everyone. We're going to give just another minute or two here for people to get joined onto the webinar, and we'll get started. Thank you. Good afternoon, everyone. Thank you so much for joining us. Welcome to Thoughts on the Market. I'm your host, Tim Ralph, Chief Operating Officer and Co-Portfolio Manager for Biltmore Capital. Every week, our team and I come to you with the latest insight on the financial marketplace. We're also heavily focused on the long-term picture and what this means for your wealth. We spend our time working with a lot of our clients and understand their financial picture, and really we're out to help you diversify and get you a well-managed portfolio to achieve your financial goals. We hope you find the panel today to be very valuable in giving you some perspective on some of the recent negative price action in the global equity markets. We're recording this on Wednesday, October 31st at 1:30 p.m. Eastern, so let's get after it. I'm joined today by members of our executive committee, Chief Investment Officer Don Chambers and Chief Executive Officer Tyler Vernon. First, I'd like to introduce Dr. Don Chambers. Don is our Chief Investment Officer. He chairs the investment committee for the Biltmore Select Portfolios, and he currently serves as an Associate Director for Programs at the Chartered Alternative Investment Analysts Association. Don today is going to just chat a little bit about some of his insights and what he's been seeing in the market. And right now, I'd like to hand over the floor to Don.
Thank you, Tim. Could you advance to the next slide, please? I have a picture of a roller coaster here to symbolize how scary the last month has been with its ups and downs. And it seems like just about the time things look terrible, they reverse and vice versa. So I think it's a good time for us to talk about wealth management. I like to emphasize a long-term view of taking prudent risks. And I don't want to be flippant about this, but my perception of going through these relatively turbulent times this month has been somewhat relaxed. It is a little bit scary at times, but if you keep your eyes focused on the long term, I think we'll be fine. And one thing to me is clear, and that is that when we make decisions, important decisions with regard to our wealth, it shouldn't be done in turbulent times or in super good times. It should be a steady decision that's being made based upon our financial circumstances, our goals, our attitudes towards risk. I think of risk as a necessary evil. If we don't take any risk with our money, we're not even going to keep up with inflation on an after-tax basis. So risk is the tool that we use to get higher returns. We don't like risk. This month is an example of why we don't like risk, but we need to take it. So if we're going to take that risk, depending upon our circumstances, it might be a small, moderate, or large amount of risk, but it should depend upon our circumstances, not about what's happened to the market lately. I like to think about being very well diversified to smooth out those risks as much as possible. And I think in terms of risk buckets, that we're going to put some of our money in a bucket of equity market risk that's exposed to equity market volatility. And then we can put some of our money in a bucket that's exposed to credit risk, whether bonds are going to default, or interest rate risk, or other types of risk, inflation risk. So we want to spread our money out between those buckets, and that's how I view long-term wealth management. And hopefully you're feeling comfortable at the end of this month, even though it's been difficult, that the risk levels that you have selected along with your financial advisor has been an appropriate level of risk for you. And if you felt a little uncomfortable in October, that's natural and that's healthy. But the key thing I want to emphasize here is we don't want to make decisions in the midst of chaos or in the midst of an extremely healthy market. So that's what this slide talks about, is when's the right time to make a decision. And I don't like roller coasters, but sometimes I get kind of coerced to go on them with my grandchildren or whatever. And I'm pretty unhappy during some of the ride, but when it's all over, I'm glad I did it. And I hope that's how we feel in this month, that when the volatility does simmer down, and eventually it does simmer down, we'll be glad that we didn't try to jump off the roller coaster in the middle of the ride. So if we can move to the next slide, it really talks about volatility. This is a great diagram that we've located. It's very difficult to come up with such a long-term, almost 100-year view of daily market volatility. So what this diagram shows, if you go to the left side, is right before the Great Depression, volatility was in the area between 10 and 20%. Now that's a statistical measure, and the way for us to think about it is that when volatility is between 10 and 20%, that's kind of normal for the stock market. And you see the Great Depression occurred and the volatility jumps way up to 50 or 60%, and it labels it as the crash of 1929. And then we go through and we see other times of crisis. The ones that I've lived through, of course, was the Arab oil embargo of 1973 and 74. October 1987, it's labeled here as Black Monday. October 19th, when it dropped 20% on Monday, and counting the previous 3 days, it dropped 33%. I mean, this is an enormous. If our stock market were to fall 33% this month, it would be falling 8,000 or 9,000 points in the Dow Jones. And then, of course, I'm sure everybody in the audience remembers the global financial crisis. And I remember vividly October 2008, when after having the market gone down, down, and down, it went down further. Now, this diagram is not really showing the ups and the down in the market. I've got another diagram that'll do that in a minute. It's just showing how much it gyrated up and down. So this is about volatility. If you look over to the far right, it doesn't capture October. It hasn't been updated, but it shows that our volatility was getting way down around 10%. And it's jumped since then. So if you look at the top line of this slide, it says that the current volatility is about 14%. And if you look across this almost 100-year range, you see that 14% is actually kind of average or moderate. Might even be a little below average over that long term, but I think it's consistent with recent averages. Now, I'm not saying that just October was normal, but this is a 90-day volatility, a 3-month volatility. And the last 3 months has been somewhat normal volatility. I'd also point out that there's an illusion that's occurring because when we have a Dow Jones of 25 or 26,000, a 1% movement in the market is a 250 or 260 point change in the Dow Jones. And I remember back in 1982 when the Dow Jones was at 700 or 800, that a 7 or 8 point move was a 1% move. Well, now instead of a 7 or 8 point move being a 1% move, it's a 250 point move. So when we see 250 or 500 points in the Dow, that's unusual territory for us to think about the prices moving that much. But if we think about it on a percentage basis, it really hasn't been as bad as we might think it is. The saying in the stock market is that the stock market takes the escalator up and the elevator down. And that's really what's showing in these diagrams, is that when the market's doing very, very well, if you look, for instance, in the last 10 years of this diagram, volatility is declining. So even though the market was going up and going up quite rapidly, it went up steadily. So when the market's doing well, the volatility tends to be low. And when the market's doing poorly, the volatility tends to be high. And that begs the question, can we predict the volatility on a forward basis and get in the market when the volatility is going to be low and get out of the market when the volatility is high? And that would certainly be a wonderful strategy. But I think that's not consistent with long-term wealth management for a variety of reasons. The economy right now is in great shape. The economic growth, the low unemployment, the consumer confidence, the business confidence, these things are at all-time highs. It's a fantastic economy. So one would say that I'm very optimistic about the future, but I would throw in two caveats, which I've got listed on this slide. The first one is the trade dispute with China. Now, I think that it's something that is a tremendous future uncertainty. We've seen in the rearview mirror that the trade agreement went very well with Mexico. It went very well with Canada. On a nation-by-nation basis, it's been working well. But China is special. It's special because it's such a huge economic force in the whole world and in our economy. And there are a lot of signs that this may or may not go well. I don't have any special insight as to whether it's going to be resolved, but in my opinion, that's the greatest predictable obstacle to healthy economic growth over the next few years. Maybe the second biggest predictable obstacle would be that the Fed tightening tips us over into a recession, as it did in 1979, for instance. The other things could happen. We could get into a war. There could be some sort of a huge natural catastrophe, and the stock markets could fall. But I think these are the two predictable things. I think the market is disrupted in October because that is a month of frequent disruptions. But I think it's really been disrupted by the China dispute, the Fed tightening, and perhaps by the midterm elections. Although they don't concern me, they might be concerning other investors. So I think that's where we stand now. Great economy, but we've seen some volatility lately. It's low volatility compared to what we've seen in other eras, but it's not a trivial amount of volatility, and we need to be taking it seriously. If you could move on to the next slide, please, Tim. So this is a diagram of, well, if we're worried about the stock market, if we were worried, and I'm not overly worried about the stock market right now, but if we were concerned about equity markets, what would we do with our money? Well, the primary alternative to being in the stock market is to be in the bond market. And we want to look at that as to whether this is a time then to rethink our allocations to bonds. Well, on the one hand, the interest rates are higher now than they've been, which gives us an idea that maybe we do a closer job to being able to keep up with inflation on an after-tax basis. But if we look at the first point here, long-term treasuries have been down almost 10% in the last slightly over a year. And I remember in the early 1970s when the 30-year Treasury bond lost 40% of its value. So long-term bonds can be very risky. So I don't think we should put a lot of money in the exposed to interest rate risk. We should have some interest rate exposure. Biltmore Capital about a year and a half ago was concerned that long-term interest rates had almost nowhere to go but up. So we really took a lot less interest rate risk, and it's been helpful to our returns. We don't have any non-trivial holdings in very, very long-term treasuries. The other risk that we can take in the fixed income market, trying to earn a higher return, is credit risk. And that's what this diagram really speaks to. And if you look at the orange on the top or the gray on the bottom, these show the credit spreads. When credit gets very dangerous and people think there might be a lot of defaults, these things spike upwards. And when things appear very safe, the credit spreads get very small. If we go all the way over to the right-hand side of this diagram, we see that the credit spreads on high yield debt is actually at virtually a long-term low. The credit spreads are very low right now. They're moderately low even in the investment grade bonds. And what that means is, to some extent, credit risk right now only has one way to go. Everything is looking so good that it's possible that the credit spreads could get smaller, which means that being in these types of bonds would be good before that happens. But I think we're concerned that this is not a great time to take credit risk. We moved our credit risk about a year and a half ago from high yield bonds into senior notes, largely speaking. And we think that senior notes, although in terms of short-term market responses, have a lot of credit risk, we think in the long run, they're well positioned for bad scenarios. And that's where we're taking the credit risk. We think it was a good call then. We continue to think it's a good call now. So just summarizing this slide, I don't see bonds as being highly attractive or highly unattractive. We're not taking a lot of interest rate risk, and we're choosing our credit risk carefully. I don't think this is a time to jump into or out of the bond market, because as long-term wealth managers, we want to make decisions like that very slowly and very carefully. And if you could move to the next slide, please. Great. This is a diagram of the US stock market over the last slightly over 20 years. And it shows, going from left to right, this great market we had going up until late 1999 or early 2000, when the stock market, we got out of the growth and it fell, and then it went into another bull market, which we see going into the financial crisis. And then the financial crisis drove it down. And then we see for the last 10 years, it's been going up and up and up until lately, on the very right-hand side, you can see the recent dip that occurred. And as we look at something like this, we begin to ask ourselves the question, well, can we study this to find out when we should increase or decrease our allocation to equity? And I come back to this idea that our allocation to equity, which is our biggest decision, should be based not on whether we think the stock market is hot or cold, but more on the basis of how much risk are we willing to take to get higher returns. Now, that's not an absolute comment that we don't try to do anything to prepare for better or worse equity markets, but we don't want to overreact to equity markets. For instance, in 2015, when the stock market had reached a very attractive high and started to pull back, if we jumped out of the stock market then, we would have missed that fantastic stock market that occurred after the most recent presidential election. And we see it dipping now, and we wonder, oh, could this be the start of the sort of downturn that occurred in 2000 or in 2008? And it could be, but it could also be a little resting area to start the momentum upward again. I've noted how incredibly strong the economy is. I think decisions with regard to cutting tax rates and cutting regulations and the technology that the U.S. is such a leader in are indications as to why this could go up a lot further. We're going to have another slide later that talks about that. But the general message that I want to get to is to stay the course and stick with the tried and true long-term wealth management principles, which are not trying to guess the next market movement as much as to just making sure that everybody is taking a level of risk with which they will feel in the long run comfortable. Even though there are going to be times like this month where it feels uncomfortable, for the long term, we want to make sure we're taking the right level of the different types of risks. Tim, I think that you're going to take it from here, or Tyler.
Yeah, thank you, Don. That was great. Hi, everybody. This is Tyler Vernon, CEO of Biltmore Capital. Wanted to talk about a few other things. Before I get into that, I just wanted to mirror some of Don's comments about the economy. As we sit here and we talk to clients on a daily basis, especially over the past month, I'd say that, you know, we've talked to a few people. I think most of our clients are relatively secure with what's going on, not of course excited about it, but we have spoke to some clients along the way, and I want to echo Don in saying that nothing much has changed over the last month. People were excited about the market a month ago, and I would go so far as to say that things potentially are even looking better. Obviously, the market has fell to provide better entry points. We're in the middle of a corporate earnings season, and 65 to 70% of companies are beating expectations. We had a GDP forecast that came in hotter than what most people thought. And as we think about this related to 2008, which it's really apples and oranges, but as we were sitting in late 2008, I remember looking at shrinking earnings numbers and shrinking numbers on the GDP, and it was really just not a great picture. But as we look at the data today, and of course we can always be wrong, but as we look at the data, we're seeing signs of a healthy economy and a healthy corporate America. And as we continue to move on over the next few slides, we'll talk a little bit more about that. But so Don, as we look at market timing, we've had a couple of comments about, hey, is this the time? Markets are down 10%. Is this a good time maybe to sit on the sidelines? And we had a couple questions come in from some clients talking a little bit about this. You know, what should our strategy be? Should we take some cash off the table, potentially out of stock, and just sit in the sidelines, Tyler, until the smoke clears? And this is a very interesting slide. And what I'm trying to say here, especially with these smaller dips, is it's very hard over the long term to time in and out of markets. And because of the laws of randomness, I think what anybody will see is over short periods of time, it's very possible to do that. But remember, when you get in and out of markets, you have to be right twice. You might get out of markets and see the market move back down, but you have to be right again as far as getting back in at a time before the market rallies back up. And of course, we're incurring taxes in a lot of cases and fees to do that sort of thing. But what this chart looks at is some of the dangers of market timing. And it looks at this period of time that Don was just referring to, from the late 90s to the end of 2017. And all the way on the left, if you look at the fact, if you were invested in all 5,217 of those trading days and held through them, you would have been up about 7.2% annualized. It's a pretty healthy number. And remember, the period of time we're looking at looks through 2000 to 2010 as described as the lost decade. Stocks went down for 3 years in a row during the dot-com bubble bust. 2000 to 2003, they rose to 2007, they fell again in 08, and it wasn't until 2010 that they reached their level that they hit in 2000. And then, of course, we're looking at a period of 2009 until today, now the longest bull market in history. So again, I think we're looking at a good period of time of different interest rate cycles, presidents, different wars involved, and lots of different periods to look at. So 7.2% a year. As you see the next bar chart to the right of that, it shows that if we missed just the 10 best trading days, 10 days out of 5,217 trading days, our return would have been down to 3.5%. And this isn't looking at taxes, the fact that you might trigger taxes by making some of these moves. If you missed the best 20 trading days over those 10 years, your return wouldn't have even beaten inflation. You're down to a little over 1%. And you can go all the way to the right. And if you missed the best 50 days out of, so 10% of the trading days, about 10% of the trading days, if you missed those over the last 20 years, your return would have been negative 4.5% annually. So I think this is a pretty interesting chart. And by the way, this chart is from Morningstar. Most of you know Morningstar. They're an independent rating agency. They are paid strictly to do research. And I think a firm like that is a good place to obtain this research from. So again, the risks of missing some of the best days in the market, and a lot of that is, again, you go on the sidelines and a comment will come out of the blue from the Fed or from the president, and all of a sudden one of these big risks, and for example, it might be China, it just goes off the table, and we could see a market up 4% in a day, and when you're out of it, obviously you're not participating. So we're urging clients to not take, at this point, any drastic moves to go to cash or to try to time this pullback. We can go on to the next page. We've talked to clients, I'd say, over the last few months and more over this month about what happens during midterm elections. And I'm here to say that I think we have some pretty rosy news. At least the statistics are showing that markets typically perform very well after the mid-year election. It makes sense that in times of uncertainty, markets typically gyrate. We see that again, leading up to this most recent presidential election, when Hillary and the Donald were going at it, there was a lot of volatility coming up to the election. And once the election took place, the markets were down 1,000 points. But in the pre-market, but at the end of the day, the markets were up huge and continued to have a big year in 2017. And let's take a look at some of the data here. To give away the punchline, the S&P here in general has been up 86% of the time, with an average of about a 6.5% return in the fourth quarter of the midterm election year. And this is from our friends at Bank of America. As we look into this chart on the left, let me describe a little bit what we're looking at. There's a lot going on. What this is looking at are charts of the S&P 500 during the mid-year election from 1928 until the present. And if you look at the bars on that chart on the left-hand side, what it's looking at are the average months or the average returns of 3-month periods. So on the bottom left, you'll see that January to March, on average, the market was up about 0.73. February to April, the market was up on average about 0.6. But look what happens as we start entering into concerns about the mid-year elections. March to May, markets down on average. April to June, markets down on average. May to July, down. June to August, down. July to September, down. And as we look at different periods of time in the fourth quarter, which is what we're going into now, it's a lot more positive. Again, August through October, on average, up a little less than 1%. September to November, on average, up about 3.4%. Finally, in the fourth quarter, October to December, on average, up 6.37%. And if you look at that number just above 6.37 on that bar chart, it shows that 86.4% of the time the market has been up in a mid-year election time in the fourth quarter. So while history certainly isn't an indicator of exactly what's going to happen, these types of numbers make sense to me, that once the uncertainty is off the table, we can now move forward. We know what the playing field is like, and the uncertainty is behind us in the market. Moving on to the chart on the right, we'll talk about this a little bit differently, and maybe some of you can better understand and remember some of these periods of time. In 2002, under Bush and the mid-election year, remember what was going on in 2002. We were at the third year of the dot-com bubble burst. So just trying to give you a little bit of perspective of what was going on. But leading up to the mid-year elections, the market had corrected about 34%. And mind you, again, some of that had to do with a dot-com bubble burst. But what happened 1 year after the correction? Markets were up 34% the preceding 12 months. Going on 4 years later, 2006, Bush again. Markets down 8% leading up to mid-year elections. What happened in the next 12-month period of time? Markets up 24%. 2010, Obama, 4 years later, 16% to the down leading up to mid-year elections. What happens 1 year later? Markets up 31% from that low. Finally, last time, 2014, markets down 7%. What happens 12 months after? Markets up 9%. So, these type of things, when I look at this and I combine this with what we were talking about as far as what's going on with corporate earnings, what's going on with interest rates, although they're going up, they're still relatively low, they're still accommodative. It makes me feel good about where we are and where we're headed at this point. So turn it back to you, Tim.
Thanks, Tyler. Thanks, Don. So we're going to open the floor to some questions. We did have some folks that sent in a few ahead of time as they couldn't make the meeting here, but maybe to pose a question to Don, if I could still get him. One of the questions that came back was related to the stock market. And the question goes that instead of focusing so much on the broader indexes, the large cap, mid caps, and small caps, is there any insight into looking at other different types of strategies like dividend only or dividend appreciation type of index funds?
Well, that's a great question. The rage in academia, and as well as in the practical research, is what we call factors. We're trying to take and break the overall movement of the market into all the sub indices or all the sub factors. And all of these professors and all of these investment professionals are spinning data regressions and files to search, is there any way we can ferret out a subgroup of the stock market that's going to outperform? And there's some very famous research, they're called the Fama-French factors, that say it does appear that, for instance, size matters and perhaps small stocks do better. And then very clearly, the long-term history tends to indicate that value stocks outperform growth stocks. And there's all sorts of factors, momentum and quality and on, dividend and dividend growth. And there's literally hundreds of sub-strategies that people test. And as with any test, even if there's no underlying relationship, with enough tests, you're going to get a lot of false positives, a lot of signals that say, oh, this strategy is going to beat the other strategy. And I want you to know that I'm on top of this, as the entire Biltmore team is, through our investment committee meetings. And we're looking at those factors that have two incredible justifications. The first is that in a very long-term history, they seem to have performed well. And that's certainly the case of value stocks over growth stocks. But the second is that there's a logical reason as to why we think that what's happening is happening. Is there an explanation to it? So we do have what we call tilts in our portfolio, where we look for factors that we think satisfy those two criteria of being long-term empirically validated and long-term theoretically justified. And we put on very mild tilt. It's not market timing very much. It's really a general favoring of those factors that we think there is evidence, theoretical and empirical, to support a higher allocation to than the rest of the market. So if you look at if you're a Biltmore client and you look at your portfolios, you can see that we break it down into size and growth versus value. We can pick managers who can try to time the market time those factors, I should say, or emphasize those factors better. Right now, I'm not convinced that after you consider taxes and fees and lack of diversification, whenever we tilt in a direction of one segment of the market rather than another, it makes us a little bit less diversified. Right now, we think there are those only two factors that we've identified that we think satisfy that criteria of theoretically justified, empirically justified, worthy of the extra taxes and fees and transactions costs that causes. So I listened. I hear about other factors, dividend growth factors, for instance, and we don't believe there's enough evidence to justify those at this point.
Thanks, Don. Another question from the audience. I know you're and I'm not going verbatim here, but I know you're a pioneer here in the closed-end fund space. Have you been noticing any new discounts or any opportunities in that area?
Yes, the discounts have become more attractive, which is very helpful on a go-forward basis to increase allocations. We've seen some, I consider them to be quite attractive discounts, and we've made movements accordingly. And given the market turmoil in October, we don't want to be premature jumping too far further into the closed-end funds, because closed-end funds are great in the long term, but when a crisis does occur, those discounts tend to widen. Well, that's a buying opportunity, but we can't sit around forever waiting for a crisis. So we put some exposure on to closed-end funds, and then when the crisis in our judgment gets deep enough, then we go into the maximum appropriate exposure to closed-end funds. So yes, they're getting more attractive. We're moving into them on us, but we're not going wildly into them at this point right now, because we want to save some dry powder, if you will, to exploit even higher discounts should they come along.
Great. And Don, maybe this will be the last one, but we did have a couple of questions discussing the international and emerging markets. Maybe you can make some comments in terms of Biltmore's tilt and strategic approach in allocating towards equities and in domestic versus international and emerging.
That is the toughest question in investments, in my opinion, and that is that to me, I feel extremely confident in how we allocate between large, medium, small caps, growth and value, even between equity and fixed income. We work carefully with our clients to make sure that they're taking an appropriate level of equity risk versus fixed income. I feel it's so easy. I don't mean to be flippant about it, but I feel just great about those decisions. I think the most controversial and difficult decision is how much we should put into international equities versus domestic equities. Theory tells us that we should weight each asset class according to its market size. And if we were to do that, we would be 35% in US stocks and we would be 65% in international stocks, which those of you that are following it know that international stocks have done very poorly relative to US stocks in the last year or two. So some investment professionals out there are buying into this theory all the way, and I'm not criticizing them, and they've put 50% or even more of their money in international equities because there is a very good explanation as to why people ought to do that. But there's another side to the story, and that is that the US equity markets are familiar to US citizens. It's what we see in the television every night. It's what our neighbors are earning. It's what's occurring in our own economy. It's reflective of what's happening in our economy. And a lot of people, I think, persuasively argue that because of these behavioral issues, they should have a home country bias, that they should put more of their money in the domestic market, in the US market, than theory suggests. So in that argument, you'd say, well, maybe we should be 80 to 100% in US stocks. The argument against that is, well, that's not very diversified. If something bad happens to the United States economy, like a major bout of inflation or a trade war with China, we don't want to have all of our eggs in one basket. I think we've struck a middle ground at Biltmore Capital. It's of around 70% US, 30% international, it varies, or 75% domestic. I think that's a balance in this very, very difficult. If there's one decision that causes me to sometimes lose a little bit of sleep at night because I care so much about managing other people's money, it's this decision. It's a very difficult decision. We're kind of in the middle of the spectrum right now, and maybe that's the right place to be when there are no clear answers. But it's a long-winded answer to a very important question. And but what I guess I do want to emphasize is that we're not deciding between international and domestic markets using our some market timing, aggressive market timing strategy. We're not doing that. We're trying to take the appropriate risk return balance for a long-term perspective of accumulating wealth. And I think we've picked a good level. Obviously, in the rearview mirror, we wish we'd been 100% in U.S. stocks, but that wouldn't be prudent, in my opinion.
And this is Tyler. I just want to mention one more piece of that. Not only our research, but as we pull our research about institutional investing, specifically, what are some of the larger endowments doing with their money? We see reports about the fact that some of the larger endowments, over $1 billion, are putting half their money internationally and half here in U.S. equities. And as we look at endowments that are smaller, 100 million or so, we're seeing that in general they might be putting 60 to 70% of their money in U.S. and 40 to 30% internationally. So as we compare ourselves to the larger endowments of the studies that we see, we actually do have a larger tilt to United States equities, which has certainly done better over the last 10 years. And I do want to point out that last year, international equities did outperform. And of course, this year, because of trade war and other issues and the strength of the U.S. economy, U.S. is certainly outperforming. But Don, thank you.
Thank you, guys. And Don, I guess we'll leave. I'll give you one last question here and a good note to part on. Maybe you could leave a little bit of the 2019 outlook on the table. I know we're not there yet, but some things to think about as people enter into 2019. Maybe you could leave us with some departing words of wisdom.
Well, Tim was talking earlier today about how attractive the PE ratios are right now. The earnings of the corporate equities in America right now are approximately 6 to 7% of the stock price. So from an earnings perspective, the stock market right now does not appear to be overvalued, yet the economy looks so strong. I mean, I've never lived in such a healthy economy with 4% annualized GDP growth, with unemployment at record lows, consumer and business confidence so high. Now, that doesn't mean that's changing our allocations, but it means that we're certainly comfortable with staying in equities as we've been staying in them for many years now. I think that the general message I'm saying is stay the course. But here's another thing that I want to tag on to that, and that is that if your financial circumstances change, maybe it's a job loss or winning the lottery or whatever it is, it's time to revisit that allocation. And when the dust settles on this most recent volatility, if you look back in the retrospect and you say, that just wasn't worth going through. That was more uncomfortable than I can bear. And if you feel that way a month or two from now, then or even now, you should talk with Tim or Tyler or Justin or Adam or me. I'm always available. And see, well, maybe you don't have the right allocation, but the right allocation should not be based upon what's happened in the past 2 months or our predictions of the future. It should be this trade-off between risk and return and what fits.
Great. Thank you, Don. And thank you, Tyler. I want to thank everyone today for joining us. I ask that you can visit our website, www.biltmorecap.com. We post a lot of good stuff on the blog and the media sections, as well as anything new that's coming forward. Also follow us on Facebook. Pretty cool stuff that goes on there pretty much weekly. And you can always give a thumbs up and like us. So again, everyone, thank you so much for attending. We will have some replays if you missed some of the beginning of the call. And feel free, please, don't ever hesitate to reach out to your advisor or give us a call. We invite you to do that. You guys have a great day, and we will talk to you soon.